Hey fellow traders, today I'm going to talk to you about the evolution of the eye-opening free trading strategies out there. 30 years ago when I started trading, they didn't have any free strategies. You had to buy a course, you had to figure this out. There was no easy way. In fact, we didn't even have computers. Hey, I'm Rob and it's Coffee with Rob. So we're going to have some coffee and then we're going to go and talk about all the strategies available out there. Not to mention how it all started for us. I mean, we didn't get those free strategies that you've got now. Let me tell you the story. When I started out, effectively what we had was pens and pencils. We didn't have any computers. Computers were sort of first being brought out. Yes, there were computers, these big things with these tapes on the walls that were running back in the political offices in huge buildings the size of Facebook, to give you 5 megabytes of memory or something to that effect. But the home computer as you know it today didn't exist. The mobile phone as you know it today, we only dreamed of. I mean, I used to watch it in Star Trek. And yeah, I remember in Star Trek, you would sit there and you'd see this guy open up a phone and a flip it would go, beam me up, Scotty, this planet sucks. Yep, perhaps. I am going to show you a system on the charts today, and I'm also going to show you the strategy that makes you money in the markets. But first, I'm going to talk about how we got there, the story of how we got to these systems in the first place. When we started out, what we used to do, when I took a course, I can't even remember what the course was called. I paid what in those days was an absolute fortune for it. It was a few bucks. And they sent me this course, and do you know what? I sat there and I actually figured out that you had to draw a line through the price, and that was kind of your 20-day moving average. And effectively what we did was we bought when it was above the line and we sold when it was below the line. Effectively, I basically use that strategy today simply to invest. There's no trading involved in this. What they promoted to us is that you can make loads of money while it's going up, and then you can sell it at the top and wait for it to come down and buy it again and make loads of money while it's going up again. And that was the basic principle of trading 30 years ago. If you think about it, it's kind of insane, because effectively, how do you make money out of that? Effectively, there was no leverage trading for one. You didn't get any leverage trading, gear trading as I call it. What you got was simply one-to-one. If you wanted to invest in the market, whatever money you had in the bank, you could invest in the market, and that was it. There was no, if you invest $1,000, you can buy 10,000 rands worth of shares, or if you invest 10,000, you can buy 100,000 worth. There was nothing like that. That didn't exist. Futures were something that we didn't know about, and as retail traders, we were kind of retail investors, and that's where we grew the adage, time in the market. Timing the market is near impossible. We coined the phrase, time in the market wins. And that's when you start to learn, hang on, I have to invest to make money out of the long term with these shares. And the only thing we were trading effectively back in the day was shares. But then I got my first home computer, my first home PC. Do you remember the dial-up sound? Dee-dee-dee-dee-dee, or something to that effect? I mean, I'm making funny noises now. You guys are going to laugh at me, aren't you? But yeah, okay. The dial-up phone, the dial-up internet, the whole 9 yards. And do you know how expensive internet was back then? Do you have any idea how much the internet cost to run? It was insanely expensive. So what I used to do was they gave us a floppy disk. We didn't even have hard disks. We had the hard disk, but I mean the external was like a floppy disk, and then you got the stiffy disk, and then you got the CD. So we were still on the floppy disk, and you stuck the floppy disk in and add a few megabytes on it, and it had my share program on it. Can you imagine my first share program? Put it in there and a chart came up on my screen. This was crazy, man. This was something really interesting to look at. And I put it on the screen and I could actually put a 20-day moving average in it. And it worked it out for me. It actually worked out the 20-day moving average. And I thought this was the bee's knees, man. You can't go wrong with this now. But you're offline. So what you do is you take the data that you've got. So this is not on or real-time data. We're not running real-time here. So you've switched off. You've got the data effectively from yesterday, and you've got it all in the chart. And what you do is you take your moving average, you put it in there, and you make your calculations as to which share you want to buy or sell. And then you put the internet on, dial up, and then you download all the information you need for tomorrow so that you can start all over again. It's the first PC. That was how we all started. And would you all believe that we started with the moving average? Probably the most lagging indicator you will ever find on Earth, the moving average. But then along came social media, along came all these wonderful, weird, and wonderful ideas in the market. Along came proper online connections, bigger bandwidths, and bigger computers, and suddenly we were connected. Suddenly we were real time with our charts, and everyone could connect directly to the market and buy and sell. The spreads were insane, but you could buy and sell on the computer now. So you could connect your computer and you could be directly in charge as you are now, and you could be connected to your broker. So the brokers started to come along, and with that, along came leveraged trading. Now, when leveraged trading came along, you have to understand that we had no understanding of what this can do. We thought this was good. Leveraged trading. Here we are. We've been investing for a few years. The computers have gotten wise. You still couldn't connect for the whole day and leave the computer on all day because it was still expensive. But it was much better. You were now connecting in a much better way, and the lines were, just because they were new, more expensive. It's a bit like when the latest model TV comes out or the latest model phone. It is kind of expensive and then it drops in price as time goes by, and that's kind of what happened with trading systems or computer bandwidths and that sort of thing. So here you are, you're connected and you're choosing all these different systems to trade with. Suddenly they've come out with all these moving average crossovers, they've come out with the MACD, they've come out with a couple of fancy little indicators that go on these charts. Not amazing stuff like you got now, but quite a lot of indicators were available to us that we had to learn how to use, because we were still trading on the old moving average. So we carried on kind of trading on the moving average. And nothing really changed that much when the computers came out, but it's just that they came out with so much more. But we still had a situation where you would take your trades and then switch the internet off for a while, and then come back and switch the internet on and see what's happening, and then the live would all come back and it'd show you what's going on. Because we didn't have unlimited bandwidth, we didn't have unlimited gigabytes to trade with. You had a limited amount of internet available to you. So you could buy 50 gigabytes of internet for a certain cost, and that was your internet for the month. And if you needed more of it, you had to pay more. So it was kind of expensive. It wasn't like now where you switch the internet on and you can go to the moon with it, and it's completely different. So we got over that period, and then we moved on to the period where internet became unlimited. We got onto the period where you had all these amazing indicators available to us. Tons and tons of indicators. Now, in this time, you can imagine what happens. You start adding more and more and more and more and more indicators on to your charts one by one. So you've got a chart that looks like a mishmash of lines everywhere. And of course, what is the first thing a trader does? They go and get more monitors, put them all over the place. Yeah. Now you've got 3-4 monitors lying all over the place, and they're all connected to your massive computer, and there's all these charts all over the place. The other thing I did was I had like 20 charts on one monitor, all up at the same time. Not realizing how that's confusing me, how it was driving me completely insane. Because I couldn't really tell which chart to choose and which chart not to choose, and so I was quite confused. And then the aha moment came to where I said, I'm really trading against myself here. I've got all this stuff up. I've got so many things going on. I'm trading with so many systems, so many different systems, and one system says buy and the other one says sell. They all work because the market's 50-50, as I always tell you. The trouble is, it's not the system that makes you the money. It's the strategy. And the whole time you've been thinking the system's making you the money. It's just as simple as when it goes above the 20-day moving average, buy, and when it goes below, sell. That was what we thought. We had no idea about managing risk or this or that or the other. There was nothing like that. There was a thing called stop loss. You know what stop loss when we started? Stop loss was 10% when we started because we went in leverage trading. So in other words, if I took a trade, I put a 10% stop limit on it. 10% was huge on any trade. Massive. So that, you know, seldom got stopped out. Stop loss was easy to control. Come on. Not difficult now, is it? Then leverage trading comes along. And the first thing you do is you take trades with a 10% stop loss. And then you realize that a 10% stop loss effectively wipes out your account. And then you think, oh, got to rethink this whole thing, got to rethink the whole project. This is costing a lot of money. And you know how many people lost a lot of money when leverage trading came out? Because they had no idea whatsoever what this leverage trading would do to them, because the calculation wasn't there. Then we figured out, hang on a minute, this is tricky. We need to change a few things here. And Forex came about. You could trade Forex, you could trade commodities, you can trade indexes. Now all these different things have come about in the market. Forex was so fast for us, it was insane. These days you add crypto, it's even faster, and it trades 24/7 every day. Now you get involved in this and it just keeps on wiping you out left, right, and center, because you just can't get a grip on what's going on, which is why I invented the strategy that I show you guys in every single video. So I'll tell you what, guys, let's go and have a look at the system, the price action system that we use, because what I did was I took all the indicators off the chart because I said, this is crazy. Took them all away. I started trading with a single chart in front of me, and I kept things simple. And suddenly, the world became so much clearer, so much easier to trade, so much easier to work with. Let's go and have a look at the charts, and then I'm going to talk to you about strategy that's actually going to make you the money in the markets. It truly is so much easier to trade these days. It's quite unbelievable. What I'm going to do, I'm going to show you on this is the euro US dollar. I'm going to show you on this how we trade. And it's quite simple, really. We trade three ways. We trade with the trend. The trend is your friend. We trade in a range, which means we trade in a range is basically if you are trading, I'm just going to take a pencil here, in between these resistance and support levels, up, down, there you sell, there you buy, there you sell, there you buy, there you sell, there you buy. That's as simple as trading in a range gets. Trading in a trend is very much the trend always, it never goes up in a straight line. It goes up, it goes down, you buy, it goes up, goes down, you buy, it goes up, goes down, you buy, it goes up, goes down. So that's a trend. You're in that trend, you're buying constantly as you go up, or vice versa, selling. Then we counter trade. A counter trade is something like this on the right, where you get a trend going down, it goes up, it breaks out of the trend, and then you buy as it breaks through that trend resistance, and it's going to the upside. That becomes a buy. How do we get these levels? Well, effectively what I do is I trade on the 4 hour, but I take my levels mostly from the day. So I go to the day chart, and then I take it to a line chart. Now, why do I take it to a line chart? I take it to a line chart simply because I get closing prices on the line chart. Let me just delete this so that it's not in the way. So what we have here is an area of resistance. In other words, an area where the price gets to and it comes down every single time. That's what's been drawn at the top here. The reason we've drawn it is because it was a few times it hit the top here and then it came down. It hasn't been up there for quite a while. It did come through and break through what was a support and headed on down, and then it came back, retested it as a resistance. So this became a resistance. It came down from there, it came down from there, it came down from there, it came down from there. But it was also a support. In other words, it was supposed to support it there, but it broke through. So what's happened here? It's come up, come down, come up, come down, come up, come down. It's come up, it's retested, and it's broken through to the upside. Come back, retested again, and said to you, hey, this is now support, and gone back up. Now this is on the day chart. We draw these in rectangles because in rectangles, it's an area. What your job is in the market is to look for areas where there might be some money, where there might be some liquidity, as we call it. And the liquidity as it stands at the moment is where the price gets to and comes back, or the price gets to and goes up. A resistance and a support. There are more support levels further down, but we're not going to draw them all in. It's not necessary. The price is not there at the moment. If this price breaks through here, you can come down and draw another support level in down here, another big rectangle, giving you another level. But now what you want to do is you want to take your trends from your 4 hour. So what you do is you go back to the 4 hour and you say, well, what have we got here? What does it look like? It looks to me like as it stands at the moment, it's kind of been trading in a range here. It's broken through and it's staying in this range. It's going to the top, it's coming down. So it's probably going to, in all likelihood, probably going to stay in that range. To make sure that we're not going to lose out with that, we can draw a trend line in and say, well, if it breaks that, then it's going the other way. As it stands at the moment, it actually broke this level right here and it went to the upside. So that's a counter trade going to the upside. Now you can take it back to the candles. Now, a lot of people will give me a hard time because I'm not using these tails to draw these lines in. And you can if you want to. But the reason I generally don't bother with them is because although they are showing liquidity, they also show you spikes. And there has been a lot of whipsaws and spikes in the market this year. I tend to try and take my levels off the line chart first, which are the closing prices. And then I will look at the trade and say, well, on this, I could actually take that a little bit out and put it on the tails. That gives me a better idea just to be on the safe side. And that is a clear break to the upside. So that is a clear long trade as it stands at the moment. And there's your support trend. So as long as it's above that support trend, this trade remains long. Effectively, what you're doing, you just draw this in, is you're effectively waiting for it to come down to there. It breaks, it goes up, it breaks, you take the trade, and it continues on up to there. It'll probably at that point maybe turn around and start coming back. That's the price action system that we trade with these days. I took all the indicators off the chart. Every indicator that I could possibly take off the chart, I took off the chart. Why did I do that? Because the more lines that you have on the chart, the more complicated it gets. I've seen people with line after line after line after line after line after line, and then moving averages, and then Bollinger Bands, and then an MACD, and then a stochastic, and I don't know how many things at the bottom here, and then a volume, and you look at the chart and you think, where's the candles? Where's the price? What's going on? It's crazy, guys. You can't trade like that. It's completely impossible to actually trade like that. But guys, do remember that trading is risky. Most traders lose money. And if you're unsure, you probably shouldn't even be trading, because trading is a 50-50 game. Never forget that. Trading is a 50-50 game. And based on that, I'm now going to tell you the strategy that I've used for years and years and years and years. I don't want to tell you I've used the strategy for 30 years, because as I told you in the beginning, we started out with pens and pencils. So we didn't really use the strategy from the beginning. But I couldn't possibly place a time when I started this, when I got the aha moment and when I started using my strategy. It's way back when. It's a long time ago. But it's the only way that you can actually get an edge on the market, because your edge doesn't come from the system, doesn't come from here. The edge comes from the strategy, from the business plan that you're going to put in the market, from the business plan that's going to make all the difference to you in the market. Go and listen to my strategy. Go and find out a little bit more about 50-50, why I believe the market's 50-50, and why I believe a win rate will not make you money, and why I believe that the market's more subjective than objective. So now you've seen the charts. Now you know the price action system and how simple and how straightforward it is. You can add things to it like supply and demand or gaps or anything like that you want to. All the systems work. If you want to add a moving average, please feel free to do so. You want to add a Fibonacci, please feel free to do so. It's not going to change anything, and I'm not telling you how to trade. I'm not giving you advice. I'm not giving you recommendations. In fact, this is just what I do. And as I always tell you guys, the trading systems don't make you the money. The market is 50-50. Trading is risky. 60 to 80% of traders lose money swing trading, position trading, day trading on the higher time frames. On the lower time frames, the 5-minute, 15-minute, 1-minute, 99% of traders actually lose money. So try not to forget that. Try to keep that in your mind. But the strategy is simple. And the strategy is this, guys. You've got to have a business plan. And the business plan is, I want to manage my risk. Now, it's as simple as understanding it's a bit like a coin toss. If I was to toss a coin 10 times, would you agree that in all high probability that you'd most likely win 5 times and you'd most likely lose 5 times, because that's the high probability? But what if I told you, I'll let you lose 1 for every 5 that you lose, and I'll give you 2 for every 5 that you win? There isn't a human being on the planet that wouldn't take that, because that's good odds. In any sense of the word, that's good odds. You literally only need to win 3 to pay for all the losses. The market's made up of human beings. It's not made up of algorithms, maths, or squiggly lines. The market is more subjective than you will ever believe. So you are trading with human beings. Your sole job in the market is to look for liquidity, to look for those liquid areas where the money is. If you want to make money, the big thing is to make more on the wins and lose less on the losses. And the only way to do that is to manage the risk. If you have a $25,000 account, then what you do is you say, I'm going to risk 1% on every single trade. You can choose the percentage. I don't mind what percentage you choose. I use 1%, but the trick is to keep the risk the same on every single trade. Don't change it. Don't make it less. Don't make it more, because you feel better about that trade and not better. Keep the risk the same on every single trade, and then it'll work out. And then all you do is you say, that's my trade. Where do I want to put the stop loss? It's an invalidation area. So all you got to do is go look down and say, that's where the trade would be invalid. I need a $250 stop loss. Work out how much $250 is from that invalidation area back to the cost. That's the size of your trade. How many lots, how many pips, how many pairs, how many, whatever. That's the size of your trade. Then just make sure the risk to reward is viable. It's more than 1-to-1, maybe 2-to-1. And not just, I'm going to put a 2-to-1 risk here. Make it so that it's a viable trade. If you look at the trade, say, well, I'll definitely make that area. I'll definitely get to that spot. It'll make me the money, not just 2-to-1 and we'll see what happens. You got to make sure it can actually reach that. Now you've got your trade. Now all you got to do is manage your trade. But if you want to know how to manage a trade, go and watch these last videos. They'll show you how to manage the trade properly. Until the next one, guys, thanks for watching. Don't forget to like, comment, and subscribe. I'm back for the live shows. If you want a funded account, there are links in the description. And if you want a free Forex book, there are links in the description. Till next time, guys, cheers, ciao, and bye.